Hey there again, Joe Kelly with MIC here to talk about stop losses. Let's get into it. Many years ago, there were a lot of online trading gurus that taught everyone that stop losses were how the market makers would manipulate their trades. They believed the only way to beat the market makers was to not use stop losses and use something called a mental stop. Why did they think the market makers use stop losses to manipulate their trades? Well, have you ever been in a trade where you place a stop loss and then the stock just plummets right down to your stop loss, takes out your stop loss, and then bounces right back? Well, I have. And the exact words out of my mouth were, "Those sons of can see my stop." Well, reality is, most market makers don't care about your stop loss. Years ago, many trading gurus were teaching penny stocks or OTCs. And on the OTC market, they could see your stop losses. Back then, the OTC markets were made by actual market makers. Their job was to provide liquidity and volatility. They watched stop losses. And if they saw a cluster of stop losses, they would intently manipulate the stock to that level to trigger those stop losses and create more order flow, volatility, and again, liquidity. You know, they did their job. Those days are gone. Unless you're still trading the OTCs, and most of those don't even have actual people making those markets anymore. It's all done electronically. Markets for stocks on the Amex, NASDAQ, and NYSE are all made electronically. There is no physical people actually making these markets. Sure, there's physical people that turn on the algorithms, but there's usually just a computer doing everything. So you don't have to worry about a market maker seeing your stop loss. Sure, the algorithm could see your stop loss, but that's not what we're trying to achieve. You don't really have to worry about any market maker seeing your stop loss, running the stock down to your stop loss, intentionally taking you out, and then manipulating it back. If you are encountering this problem right now, you are experiencing something called herd mentality. There is nothing wrong with the order you are placing. Stop losses are good risk management, but there is something very wrong with where you are placing that order. Most of you that are experiencing this are placing your stops where the herd is. The herd is most often referred to on Wall Street as retail traders. Us. If we think like everyone else does and we put our stop losses at super obvious levels, sure, a market maker could code an algorithm that intentionally manipulates at obvious levels where the herd appears to be. Here are some obvious stop loss levels to avoid. Pre-market high, pre-market low, high of day, low of day, previous closing price, the VWAP or the volume weighted average price, and whole half dollars. If any of those levels sound like normal levels that you use and you continue to lose and lose and lose and lose and you just can't figure out what you're doing wrong, well, you're entering at the wrong time and you're exiting at the wrong time. If you continue to find yourself getting stopped out at the bottom or the top, well, guess what? You're part of the herd. And market makers know that, and so they use a strategy called stop loss hunting. The speculation is that the algorithms that the market makers use to generate order flow are intelligent enough to identify these obvious levels where the herd is or dumb retail and manipulate the stock to those levels to their advantage. Having seen this theory play out many times over 7 years, I'm inclined to believe it's a real thing. And there's a simple fix. Stop placing your stops at the obvious levels. A question I get asked most often is, what stop loss orders should I be using? Well, we can't tell you how to place your own trades, but we can tell you how we place our trades for educational purposes. We prefer market stops. These are stop losses where you set a specific price, and if the stock reaches that price, the stop loss will be triggered and it will generate a market sell order and exit you out of the position at the current market price. I know what some of you are thinking or have been told. Market orders are bad because you can't control the price where you get out. I understand that way of thinking because, frankly, I used to be one of those people. The other solution is a stop limit order. This one, it's a bit more complex. It's the same in the beginning as a market stop. You set the stop loss price where if the stock reaches it, you'll get exited out of the position. However, the second portion is a limit order rather than a market order. So the limit order side, once the stop is triggered, the limit order is live in the market. And you set the price that you are willing to get out of. This creates problems. Most of us have been trained to use limit orders because it allows us the ability to control the price at which we get out of the stock. However, in this instance, we're trying to get out of a trade where we were wrong. We don't need to be picky about the price where we get out. We simply just need to get out. If you use a stop limit order and the stock drastically drops against you and your stop loss is triggered, however, now it's trading well below your limit order, well, guess what? You're stuck. You're still in the position. Now you have to cancel the order and enter a manual sell to get you out of the position. And these seconds, the stock, most of the time, has gone drastically even further against you simply because you chose a limit. The best way to alleviate this risk is to just use a market stop. If some of you are still unwilling to use a hard stop, market stop, or you're still thinking that a stop limit order is the best scenario, none of you should be thinking that is the best scenario after what I just explained. If you think that that is the best scenario, you need to rewatch what we just talked about for the last few minutes. Just go ahead and rewind. Allow me to give you some advice. Continue using mental stops, right? I'm not going to put a hard stop. I'm going to use a mental stop. But place a market stop loss order well below where you would normally stop out mentally. This is what I like to call the handle. Why is it called that? Well, if you've ever been in a trade and all of a sudden out of nowhere the stock just plummets to the floor, through the floor, what are the first words out of your mouth? And there you are, the handle, just like in the car. Usually when this happens, you freeze. Now, this is where that market stop helps you. You've frozen. You don't know what you're going to do. Lo and behold, down there to protect you from yourself is a market stop loss to get you out of the position in the event you freeze. Because when you freeze, those crucial seconds are ticking by, and the stock is probably continuing to go further and further against you. If you don't have one of those market stops down there, you're probably going to stop out at 2, 3, 4 times as much as you had planned to lose in the beginning. Now you're emotional. Everything's going wrong. Now the worst part is if you don't stop out. Because you're emotional, because you looked at that number, the number's 2, 3, 4 times as big as you were planning to lose in this trade. Now you do the worst thing. You hold, hope, and pray. And this is the worst case scenario possible. And then that position ends up blowing up your account. Sound relatable? Yeah, I should know. Been there, done that. So let me share a little animation with you on how I would apply this market strategy. Here's how this is going to look. Here's our chart. Here's the setup. Right there is where we want to enter into the trade. We are long right here. This area here is where our mental stop lies. If it breaks under that previous low right here, maybe this low right here, this area is where we are mentally planning to stop. So this is our mental stop. Now, what I am suggesting here is you place a hard stop way down here, and this is your protection order. A market stop placed well below your mental stop in the event that the price goes drastically against you in a very, very sharp and quick manner. So that would be something like this. Let's say we get the bounce. All of a sudden we see something like that. This mental stop area, we might freeze because we see this big candle that all of a sudden it goes from looking okay to looking horrible. So the mental stop is frozen. We froze. Now we don't know what to do. We are completely in awe that this has happened to us. This is where the market stop comes in and saves us. Remember, the market stop really has no bearing on the price. Where you place that stop is mostly going to be geared towards your P&L, how much you are willing to lose was in the worst case scenario. The reason why we're placing it well below the chart down here is because that's based on our profit and loss, or our P&L, not based on the actual chart like that. If we want to stop out based on the chart, we can use this mental stop. If we want to stop out based on our P&L and just get out of the trade because we were absolutely wrong, we always have a market stop in place at a profit point or a loss point that is manageable for us in this particular trade. Thanks for watching, guys. Don't forget, like, subscribe, and ring that bell to get notified of all the newest content coming out each week. I'm Joe Kelly. I love your body. See you in the next one.